Let's get started. So the course of our last classes, we discussed about basic market structure down to uh, complex market mechanics. Today we'll be talking about liquidity. Remember, we did not take advanced market structure and advanced market mechanics due to we have to take liquidity first of all before moving down to that aspect. So now, what is liquidity? The inaugurated one. Now, liquidity is something we are all familiar with. It has us, uh, should I say, on a day-to-day basis. Liquidity is something that we do. Now, liquidity is something that is very broad, all right? It's something that is very broad, but I will take it slowly, breaking it bit by bit to the particular liquidity that we want to be looking at. So, firstly, what exactly is liquidity at first? Now, liquidity is just basically how easy it is to convert an asset into cash and vice versa. That is liquidity in more or less, I should say, in the layman's term. Those that are not really into finance, liquidity is how easy it is to convert an asset into cash and vice versa. All right. Just one moment, I'm coming. So, with that said, it simply means that liquidity is more or less are like it entails the whole process of converting your asset into cash. How easy it is for you to convert your asset into cash. That's kind of what liquidity is talking about. Now, let's relate it to our trading environment a little bit. Now, in every transaction that we make, there are two elements, or rather, two distinct that is always involved. All right, there are two elements involved in every transaction that we make, and these elements are the assets and the cash. All right, the asset and the cash. You cannot make any transaction without cash being involved or an asset being involved. So basically, almost all transaction, particularly in the trading environment, almost all transaction is involve the transfer of assets and cash, in which the party that will be giving out the cash will be the buyer, and the party that will be giving out the assets will be the what? Will be the seller. Right? Because if you want to buy, you are interested in something, that's why you want to buy it. That's what you are interested in. That is the assets that the seller wants to do what wants to sell for you. So you are the one with the cash. You are the one giving out the cash, right? The seller is the one with the asset and is the one giving out the asset. So you can see that at every given point in time, cash and assets in the market, they are always being exchanged for one another in the market at every given point in time. All right. Now, this brings us to our liquidity in trading, which is the ability to buy or sell assets quickly at a fair price. Right. It's basically the ability to buy or sell assets quickly. All right. Take for instance, if there is no liquidity in any market, then that particular market, I won't be able to sell or buy that easily. Take, for instance, can decide to place an order and that order won't be filled at that particular point in time. It's going to take a little while before that order will be filled. That's because that market lacks liquidity. All right. So when you're seeing a market that is moving rapidly and all that, that particular market is, should I say, is more or less have a lot of liquidity. That is why that market is moving like that, moving so fast, because there are a lot of buyers and sellers in that particular market. All right. So liquidity, more or less, it measures how easily you can enter or exit a trade without significantly affecting the market price. Take, for instance, when it comes to the crypto market, you will say that one crypto whale will exit his trade, his position, and what will happen? The crypto market will crash. That's because the crypto market have what? Low liquidity. Charlie, all those little cryptos, once one will exit, moment next thing we see is that market will start crashing for a while. That's because those little cryptos, they don't have a lot enough liquidity to actually keep the market running. So when someone exits a trade, it will show a significant, like it will significantly affect the market price. All right, we do what? It will significantly affect the market price. So that's why liquidity is very essential when it comes to the markets, when it comes to trading as a whole. But that's not the liquidity we want to look into. The main liquidity we want to look into is the liquidity that involves the smart money guys, all right, which more or less is the trap liquidity. Um, that liquidity that we want to avoid so that our trade will run smoothly. All right, now that we now understand what liquidity is all about, let's go over to talk about that trap liquidity. Now, coming over here, liquidity is just a level in the market where one particular type of order is being filled at an higher volume. This is more or less how to identify liquidity, though. You already know what liquidity is all about. Now, what we want to look into is where are those liquidity resting in the market? Now, based on this feeling here, we now know that liquidity is a level in the market where one particular type of order is being filled at an higher volume. So now we know that everywhere in the market is liquidity, but where is that particular place in the market where there's a lot of liquidity in the market? That particular place, that's what we are doing, what we are looking for. That's the liquidity we smart money concept users, traders, that is the liquidity we are looking for in the market. All right. Now, sorry about that. So, as I was saying, that's the particular type of liquidity we want to be looking out for because all this liquidity, they are trapped. All right. In our case, they are trapped because smart money guys will most likely want to manipulate the market a little bit so that they'll be able to do what? They were able to like place their trade at a better price. All right. So they have to manipulate the market a little bit. And to do so, they will need liquidity to do what? To fill in their trade. That's why they're manipulating the market. They need liquidity to do what? To fill in their trade. That's why they're manipulating the market. And now to manipulate the market, it means that they have to take some retail traders off the market first before doing what? Before entering the market. Because they take, for instance, if everyone is buying, no one wants to sell. And when there's no one selling, it means that there's no liquidity in the market. So smart money guys need to inject liquidity. How is it going to inject liquidity to the market? They have to make some people, some set of people to start doing what? Selling. Or make some set of people to force sell their position. And when a particular set of people force sell their position, when I mean for sell, take for instance, when you exit a buy trade, that means that you're doing what? You're selling off. So they have to push the market to a level at which those people we do what? We have to take off, leave the market. That means exit their buy trade. In the case, in this particular scenario. Now, when they do so, there will now be some people will be, panic sell, they will start selling. The market is going to crash, they will start selling and all that. So some people will start selling, some people will be forced to exit their long positions of the thing and all that. Now, when they do so, we then see that the sell orders that were not in the market before will significantly increase. Now, the reason why smart money guys are doing this is very simple. They cannot fill in their institutional trade because everyone is buying. So there are few sellers, or there are no sellers at all in the market for them to actually fill in those their buy orders. Take for instance, if everyone is buying, scale out, there will be less of that asset being sold. Why? Because everyone will keep on buying. So to make that asset available for them to buy, that's why they move on to manipulate the market so that those that are holding in, those that have bought already, we start selling off their own. So there will then be a lot of assets available to fill in the smart money guys offer or position. Take for instance, we only have 5 of social assets available, just 5, and the smart money guys want to buy 15. They won't be able to fill in their order because they are just 5, and many people are holding that particular asset. So what will they do? They will have to look for a way to make people let go of that asset by inducing them, making it look like, okay, this particular thing wants to go to the other direction. Not only that, making it look like, or forcing them to quit their position. That's when price gets to, when they manipulate the market to make price get to where those retail traders are placing their stop loss, and then they will then have to forfeit that particular position. So when one retail trader exits, another one exits, or one start selling, the other one start selling, another. All these ones will then make a lot of assets available for purchase, which will then increase the distance from 5 to 20. With that, your smart money guys will be able to do what? Will be able to fill in their orders. All right, that is what liquidity is basically all about. So now, where are all this liquidity resting on the market? We now know what liquidity is being used for. Where is it resting in the market? Liquidity, just like the meaning I gave to you guys, it's a level in the market where one particular type of order is being filled at an higher volume. Remember, if you look at this meaning very well, it is similar to one meaning that I gave you guys when we're talking about market mechanics, complex market mechanics, which is the meaning of order block. You should say that order block is a place in the market where one particular type of order is being filled at an higher volume. Now, with that being said, those your order blocks that you are seeing, all those ones, you know that wherever your order block is, it simply means that that's where based on what we discussed in market mechanics, that's where in the basic level, that's where these people will be. That means that's where there will be a lot of buyers and sellers. So basically, you will not only find your order block, there is rejection block, your fair value gap, and all that. You most likely see them there. But in this case, I will make use of order block. Remember, I make use of order block more often. And it's only sometimes that I make use of breaker block, but I make use of order block more often as my point of interest. All right. So with that being said, where are your order blocks in the market? Where do you find your order blocks? One of the number one criteria for order block is that it is in the highs and the lows of the market. So take for instance, if this were to be a market, you most likely see your order block in this high. Most likely see your order block resting at all these highs and all these lows. Now, during our identification of order block, this is one of the things that we look into. Like, you most likely see order block resting in all these highs and lows of thing and all that. Now, with that being said, since we have now said that liquidity are basically around where you will find your order block, it basically means that since we can find our order block at our highs and lows, then based on market structure, liquidity is resting on our highs and our lows in the market. Why is this so? It's because it is in these order blocks that people will do what? We place their trade. So if we want to look for a place where there are a lot of buying and selling activities in that particular market, is basically where people are using to enter the market or exiting the market. That is where you most likely see your lots of high volume of buyers and sellers, which is equivalent to having a large pool of liquidity. So with this, that's why we say that liquidity are resting at where? At our highs and lows in the market. So with this said, this all what we need to discuss about the introduction to liquidity and where it is resting in the market. All right. So moving on, let's go back to the basic components of let's go back to basic liquidity, which is the components of liquidity. Now we have type of liquidity. Type of liquidity, or rather, yeah, let's say type of liquidity. Now, okay, that will be all right. All right, so yeah. Now, we have two types of liquidity in the market, which are our internal liquidity and our external liquidity. For the sake of this class, I don't know if that we want to talk about the internal liquidity though, but let's go on with the external liquidity. Now, our external liquidity beforehand give rise to our market structure. All right, but our internal liquidity give rise to our market mechanics. But let's first of all go on with the external liquidity. What are external liquidity? Now, external liquidity is just a liquidity in the market that is at the extreme level of, should I say, at the extreme level of price. Take, for instance, at the extreme level of the market. If we are to say, okay, we are the extreme levels in this particular market now, we say that, okay, we have 1 year, which is our point of rejection at this top part. We have another point of rejection here. Now, these are the extreme levels that are closer to what? To price. All right. Simply means that all these levels will be the one that price most likely find rejections and all that. They are the extreme parts of the chart. All right. They are the ones that are far but closer to market. So where price currently is. So these are where you most likely see your external. This is what regard to as the external liquidity rather. The external liquidity are basically your extreme points in the market. Take for instance your highs and your lows. And in the external liquidity, we have two types, which is the buy side liquidity and the sell side liquidity. With the buy side liquidity being the one at the top here, all these ones, that means your highs, they are your buy side liquidity, and the ones at the bottom are your sell side liquidity. All right. Now, look at something very well. I did not mark this place as my sell side liquidity. That means this low here, I did not mark it as my sell side liquidity. The reason is simple. Price have taken out that particular place. So it means that the liquidity that is resting here, price have done what? Price have taken out that liquidity. All right. But you see all these ones, price have not taken them out, and that's why I regard them as my what? As my buy side liquidity. That place will not be liquidity if price have already taken it out. All right. Just like this one in particular now. This one, price are taking it out, but this one, price are not taking it out. So this one is our sell side liquidity current, while this one is our buy side liquidity. That these are the ones that are closer to price. All right. So this is the types of external liquidity that we have. Let me see if we can go further. Or if not, we will end here for today, Abby. No, it will be too short. All right, let's continue here. So this is the buy side and sell side liquidity that we have in the market. Now, based on liquidity, something you need to know is that liquidity is the most important thing in the market, and the market targets liquidity. Simply means that price move from one level or from one point of liquidity to another. All right. Price move from one point of liquidity to another. Price on than liquidity. Or rather, I should say the markets on than liquidity at every given point in time. Because for for price to be moving like that, there needs to be liquidity to actually push markets. So when markets take out liquidity, there will be a lot of money, a lot of liquidity being injected at that point in time. The market take out liquidity, there will be liquidity injected at that point in time again. Take for instance, if market is to take out liquidity at this particular level, there will be fresh liquidity that will be injected in this particular chart, in this particular market. That's just the rule of the market. Well, as for the the rules of liquidity, we discuss them during our next this day, and then we also talk about market structure, advanced market structure during the next class, which should be tomorrow. So for now, let's end here before I go to pass here on our fee carry rate. Let's end here for now. And then tomorrow we will talk better on the rules of liquidity, and then move on to talk about the markets, the advanced market structure. All right. So for now, let's end here. Do you guys have any question regarding today's class?
No, no, no.
No.
All right, then answering no question we end the class here today. Please and please, for those of you that are having difficulty with your liquidity and paying your liquidity and all that, please and please just rewatch the videos over and over again. Liquidity is going to be a tough one. Yes, it's going to be a tough one. But regardless, I'm trying to break the explanation down so that you guys will not have any issue. Perhaps just watching it for yourself, you don't understand that. That's my class on liquidity. It's very easy to grab and all that. So, with that being said, this will be the end of our class today. Good night, everyone.
Thanks, sir.